Hi there, Internet. My name is ʀᴇᴠɪᴇᴡ, and it's Friday. That means that it's time to do my weekly review. Let's take a look at what has moved the markets this week. Okay, I like to start these sessions by looking at the portfolio performance. As my copiers will know, the portfolio has been flat for a while. That's given the S&P 500, this line in green, some chance to catch up to us. For those people that would like to know why, and I know that there are quite a few of you, you can take a look at the video that's popping up in the top right-hand side of the screen at the moment. And this is where I talk about, in order to beat the market consistently, you need to sometimes lose to the market in the short term. It's a bit counterintuitive. I understand why people are curious. In that video, I explain why. Last week, we saw big tech, the FANGs, present their earnings. Some were okay, some were very good. And then we subsequently saw a massive movement, a rotation out of those stocks into other value sectors, value stocks, and more defensive stocks. This heat map, by the way, has shown us the 1 week performance in the S&P 500. So we can see that money left the stocks, and this is represented by their stock prices dropping. And these increases in stock prices were because money was flowing into those sectors and companies. We also started seeing headlines like this, and this always happens when the market slides. Bad news gets attention, and media companies want to get eyeballs onto articles, so they're big fans of pushing eye-grabbing headlines. I agree that some valuations are stretched. I agree that risk in some areas has increased, but I do not think that this is the case across the board. In addition to this, the world is forecasting major GDP growth through 2021 and 2022 and potentially part of 2023. And if GDP is growing, countries are growing, there still will be lots of opportunities in the stock market. So don't be scared out of your positions. Okay, so what might not be obvious, because the P&L of my portfolio was a touch red last month and is red this month, is that actually we have been taking profit. So this is my 3-month statement of positions that I've closed. You can see that we've closed enough positions to earn 10% in realized profit. Depending on when you copied me, you might have more or less than this amount, but for me, this is the realized P&L. And the reason that we have this positive amount is that because some of the themes in my portfolio have been performing within the timeframes that I expected. And so I've been reducing exposure to those themes. The themes, you can think of them as sub-strategies. And I've been taking the profit from those and feeding them into some of the other themes, those sub-strategies that have been delayed for whatever reason. And this is part of how we compound our returns. So take profit from one place that's performed well, move it into another area that maybe isn't performing very well right now, but that we anticipate will perform very well in the future. Okay, I also wanted to talk, I know I've been talking about them a lot, but commodities and materials. So here we can see not a comprehensive list, but just some that I follow. And for example, you can see that lumber has increased by 380% in 1 year. It's crazy. It's absolutely nuts. So the prices of commodities, they typically are cyclical. At the moment, a lot of them are massively in demand for one reason or the other. What is quite interesting to note is that gold hasn't really gone anywhere over the past year. So over the past week, a lot of these, well, you can see right here, a lot of these have appreciated quite nicely in price. I don't think I own any of them directly or even through ETFs, but I have been acquiring companies or ETFs that represent industries that are dependent on the prices of these assets. And those have done quite well in anticipation of rising inflation. So I will continue to hold those positions because I think that the inflation narrative will continue and it might even become more aggressive. And then some of these will continue to perform quite well. I think that gold, which is usually seen as an inflation hedge and hasn't done very well through the past year, is probably going to do quite well through the next year and maybe even several years. Okay, next I wanted to talk about semiconductors. So semiconductors are companies involved somehow in silicon chip making. They represent 13, maybe a bit more percent of my portfolio. And if I zoom in here, by the way, this is an ETF that I'm using as a proxy for that sector. So for the past month, so roughly from the beginning of April, there's been a slide in the price of semiconductors. And because a large part of my portfolio is made up of semiconductors, this has obviously had an impact. I don't think that my semiconductor holdings are a negative. They're probably a little bit positive, but obviously the whole sector falling has not been great for my portfolio. The reason that this doesn't really worry me and that I think we've just seen a great buying opportunity is that there's a massive chip shortage globally. Demand for chips is through the roof, and we are seeing governments pour money, investment into their capabilities to get involved and take a share of the semiconductor industry because it's a massive growth industry for the next decade and beyond. So I think we're seeing a bit of a bounce today. I think that's probably fairly soon we will see a resumption of a rally in the semiconductor industry. I think that semiconductors kind of got lumped together with ultra high growth companies because, I mean, as you can see, through the past year or so, they've grown 150%. And so after hitting this all-time high, dropping, and then, double topping, investors were probably keen to take some profit, which is fine. But I think that this rally is going to continue for years and years and years. And we've seen it at an individual company level. The companies that I own, I follow them very closely. I know what they do. I read all their earnings reports. And I know that many of them are forecasting immense growth through 2021 and 2022. So I think we're going to see some really good gains there. I've also pulled up the TAN ETF. So I'm using this as a proxy for the, as you can tell by the name, the solar industry. We can see that from the bottom of the crash last year through to the top in February kind of time frame, this ETF grew 476%. And this is for a few reasons. One is that the world is obviously going through this massive decarbonization process. So trying to move away from dirty energy production to cleaner energy production. And this is not going to be done in a year or two. It's going to take a decade, probably several decades. Countries are pushing for this harder because our world is in a little bit of trouble right now. Solar energy, by the way, is not the only way to solve this problem, and that's a massive debate, but solar will be a part of the solution. In addition to this, at some point last year, investors started anticipating that Biden would win the US presidency, and he was very vocal about saying that he would invest heavily in solar and green energy. So we saw the industry massively bought up. Some companies were incredibly overpriced, and then they sold off because, the industry was massively overpriced. This slide has been much longer than the semiconductor slide, and we can see it has been far more severe. So from that top, the market has lost, well, not the market, this sector has lost 40% of its value. So it's entered into a bear market, and it takes a while for a sector or a stock or the stock market in general to shake off a bear market. So it looks like we are somewhere in the range of a bottom. I'm not sure if the bottom has been put in, but the market has also thrown the baby out with the bathwater. there were some very, very expensive companies in the solar sector, but there were also some companies that were fairly priced. So an example would be Canadian Solar. I'm quite a big fan of Canadian Solar, as you can tell by the proportion of my portfolio that is invested in that company. It's a solid company. It's an international company. It's an established company. It's a fast-growing company that's not just forecasting growth through the next few months or year, but for years out. And it is the current value of the company in terms of the stock price. It is looking nice and cheap. SolarEdge and Enphase, I think that they are nowhere near as cheap as Canadian Solar, but I think that they also might have more growth in them, and that's why the market has awarded them a higher valuation. So, long story short, I've got a decent part of my portfolio in solar stocks. Are they bouncing? Have they found the bottom? I'm not completely sure right now, but do they have a fantastic future? Well, governments around the world have pledged billions and billions very recently in infrastructure projects. Solar and green energy are a large part of those projects, and this is a big growth industry. If you can find companies that are growing and will command a large part of that market, if you can, and they're also cheap, then good on you. You're going to do very well in the near future. Okay, so the next area that I wanted to talk about is I think I have. I'm just checking my notes. Again, I've got 13% of my portfolio in UK stocks, mostly trying to target the recovery. Now, a lot of these stocks were doing very, very well in the early part of this year, and then the EU started having issues with their vaccine rollout, and that slammed the brakes on the price action of those stocks, and they tumbled. And for a while, they've been treading water. Now we're in a position where the EU is doing far better in terms of the vaccine rollout. The recovery is starting to look very good. A lot of the companies that we own in the UK are actually UK domestic stocks and shouldn't have been affected as much as they were by sentiment in the EU, but whatever, the market is a little bit crazy. But quite interestingly, yesterday the Bank of England put out this whopper. Now, I'm not sure why this wasn't bigger news. So, by the way, the interest rates and the QE in the UK are going to stay the same for the near term. But the central bank now expects the UK economy to grow at 7.2% this year. That's faster than the growth forecast by the US. It's faster than the growth forecast by China. And it's also 50% up from the forecast a few months ago. So this is a huge, huge upgrade to the growth expectation. So I think this, in combination with the EU now doing better with the vaccinations, means that it's nearly time for liftoff for those UK stocks. All right, and then the last theme that I wanted to talk about is Chinese tech. Again, another ETF. This time, this is wrapping the CSI 300, which is, you can think of it as China's S&P 500, so a bellwether for the economy. The sell-off here, I'm not going to go into all the reasons, there were many, but the sell-off in this stock market was broad, and it was nearly 20%, just about taking the stock market into a bear market. Again, we have a throwing the baby out with the bathwater kind of situation, because many companies in China were very good value even before this happened. So now, once again, as I said before, with this kind of a sell-off, investors, they become quite nervous. It looks as though this market is put in a bottom, but it's kind of a game of chicken. Investors are unwilling to throw large amounts of money at the market unless the perceived risk has been reduced. And sometimes nothing happens other than time elapses, and then people are willing to jump back into that market. As many of you will know, I'm very, very bullish on many Chinese stocks. And in fact, China overall, having gone through this across the broader stock market, is probably one of the healthiest stock markets in the world right now. Certainly much healthier than the US stock market. So I think that the FOMO will kick in eventually, the fear of missing out, because there are so many companies that are high growth. I think one of the few places in the world to find cheap high growth companies right now is in China. And at some point the FOMO will kick in, and the Chinese market tends to be quite volatile in both directions. So I think when that happens, we could see these stocks move quickly. All right. So that's it for this week. I wanted to talk quickly about next week. Earnings will continue to be important. So I think next week runs up into just check in, until the 14th. All right, so we're going to see this set of earnings next week. Some of these companies are pretty important to the stock market or to various sectors. We've got JD, Alibaba, Palantir, Walt Disney. So it will be an interesting week from an earnings perspective. These are just some of the stocks I own. There will, of course, be other stocks that we'll be reporting to. And very lastly, I wanted to talk about the themes that are going to be dominating the headlines for the next few months. One will be chip makers. And I talked about that a little bit already, but I think that the media is pushing the story quite hard at the moment, but actually the media is behind the reality. The worst is either behind us or we're very nearly there. And the picture is more complicated than there's a chip shortage everywhere, because there are different kinds of chips and there are different industries that rely on different kinds of chips, and there are different companies that make those chips, and there's different difficulties in making those chips, etc. But for example, TSMC has said that they could probably plug the gap for all automakers by June. So, and then those chips need to get out to the various automakers, so it'll take a little bit longer. But in terms of that chip shortage, it looks as though there's a chance that problem could be solved soon, in the next 1 to 2 months. The stock market is a machine for predicting the future. So if that problem is going to be solved in 1 to 2 months, then the prices for automakers, which have taken a beating, or some of them have taken a beating, should recover pretty soon, right? So I think the media, they push these headlines, they're all dramatic, but in this case, I think that they are behind where the market actually is, or where the businesses that represent the markets, that the market represents, actually are. The second one is inflation. Inflation, I think, is a different story. Inflation is going to stick around for a while. I anticipate that inflation is going to jump, and then it'll drop a little bit and it'll level out, and that's because of supply and demand bottlenecks that we've been experiencing recently. So I think that the market might behave a little bit crazily to the news that inflation has spiked, and might not believe that it's then going to drop off and plateau for a while, and then we'll see some interesting market action. And then beyond that, I think inflation will slowly tick up over the years beyond that. I don't know that for sure, but history says that's usually how it works. And I think, and understanding how economies work, I more or less agree with that. Okay, that's it for this week, and I hope you have a great weekend, and I will talk to you next week. All right, have a good one. Goodbye.